We recently published our investment letter for the fourth quarter of 2020, and I want to give you a quick overview. In our letter, we reflect on the year that just passed, we look ahead to the coming year and beyond, and we share the investment case for an exciting opportunity that we hold in the long portfolio of our funds today. Most importantly, in 2020, we reinforced our commitment to long-term compounding of our clients' capital right alongside our own. Our resolve to own the long-term winners in attractive markets has never been stronger, and it's been demonstrated by the added exposures across both existing and new holdings. It should come as no surprise that we consider the past year to be the most arduous for us since we established Montaka in 2015, and possibly since we started our careers almost 2 decades ago. The outbreak of coronavirus in the beginning of the year would go on to become the worst pandemic in more than a century, and over the remainder of the year, it caused enormous personal, social, economic, and financial market upheaval worldwide. At the same time, the coronavirus pandemic ushered in enormous change to the way that we live, work, and entertain ourselves. Entirely new behaviours and practices became commonplace, and trends that had already been set in motion were accelerated. Large marketplaces expanded, and the winning businesses were cemented. This change has created enormous opportunity to invest meaningfully in advantaged digital winners like Facebook, Microsoft, Spotify, and ServiceNow. And they're both stable and adaptable with predictable and growing revenue and profits. We've also found wonderful opportunities in other sectors of the economy, like the payment network giants and the large alternative asset managers. And over the next decade, the probabilities are favourable for these stocks to compound shareholder value very strongly. So now as 2021 begins, we believe conditions are favourable for equities broadly. Recent record stock market levels and the violent political confrontations that we've seen in the US notwithstanding. Consistent with the outlook of Dr. Anthony Fauci, we're looking forward to being very close to a degree of normality by the second half of this year. Vaccines for the coronavirus have been approved, and the race is on to roll them out around the world. Already over 15 million people have been vaccinated, and the ramp up is expected to be exponential. Wealthy countries have purchased billions of doses, and most of their populations should be vaccinated by some time after the middle of the year. This should provide a strong defence against the virus and its disease, especially in combination with the existing social distancing, tracing and testing practices that we've all become used to. Meantime, most of the global economy will still require fiscal support, but governments remain willing to provide this bridge, led by the US government, of course, which has provided a boost equivalent to 12% of GDP. And even more than that's expected under the Biden administration. Simultaneously, global central banks are providing ongoing monetary support, injecting an unprecedented level of liquidity into the economy and keeping policy interest rates low. And together this boosts the value of equities, especially those with the predictable and growing cash flows like the ones we've consolidated around in our long portfolios. We're also witnessing closure on some geopolitical events that once presented heightened uncertainty. Britain reached a trade deal with the EU on New Year's Eve, and the US election results were finally certified, confirming a blue sweep, albeit by the narrowest winning margins in history, which should mean some return of functional cooperative politics in the United States. In the near term at least, we're most likely to see additional fiscal stimulus buffer the economy, as well as broad infrastructure spending. The first year of the Biden presidency could be very stimulatory indeed, and he should be less disruptive and unpredictable than President Trump ever was. Regulation of big tech has come into focus over the past year in both the US and in China, but it'll take some time to work through, and we think it's unlikely that any resolutions would particularly onerous on operations or business value. So even as risk levels moderate on balance and the probabilities of favourable outcomes increase, equity markets have continued to rise following their sharp rebound earlier in the year, and they're now at record levels. But we believe the collection of businesses owned in our funds remain substantially undervalued. They have lasting advantages, adaptability, highly predictable and durable cash flows, large expanding existing markets, and additional opportunities in new marketplaces that are often unrecognised or underappreciated by the stock market. Many of these portfolio investments are the digital winners or data-driven. But of course, we've also made attractive investments in excellent businesses outside these trends. And in this quarter's letter, we present the investment case for Blackstone, the world's largest alternative asset manager, with more than $500 billion in client assets. Away from markets in the portfolio, a highlight of this quarter came at our annual Montaka Day, which we conducted virtually for the first time this year. Our team had the opportunity to participate in a discussion with a mental skills coach for the All Blacks, the world's most successful sporting team. One piece of advice stood out as a guide to lasting success for us. Be radically traditional, preserve the core and disrupt the edges. Earlier this year, we reinforced our commitment to long-term compounding of our clients' capital right alongside our own. This is our core, which we've preserved by focusing on the long-term winners in the most attractive markets. And at the edges, we're working tirelessly to ensure our processes, risk controls, and portfolios are continually being improved and updated to capture excellent investment opportunities. At this time, I just want to thank you for your trust and support over the past year and all the years that you've been invested together with us. We know that there will always be ups and downs from year to year, but at the core of Montaka, we have the right team, the right structure, and the right philosophy to compound your capital alongside our own over the long term. Thank you.